Let me break down how this table works so you can picture it clearly. Imagine a simple grid with four columns: the fiscal year, your initial capital, a steady 25% growth, and your total capital at the end of that year. Now, let's look at the numbers. If you start in year one with an initial capital of $100,000, a 25% growth adds $25,000 to your account. This brings your total capital to $125,000. Here is the magic of compounding. In year two, your new starting capital isn't the original amount. It is that $125,000. Another 25% growth now adds $35,000, bringing your total to $160,000. Do you see how the growth amount itself keeps increasing? By following this exact rule, after just 4 years, your capital doubles to $250,000. By year 9, you hit the $1 million mark. And by year 10, your total capital surpasses $1.25 million. This is exactly how sustainable growth builds extraordinary wealth, step by step. I believe I have managed to show you the true outcome of a logical and well-structured business. Of course, do not forget that during this journey, you will also gain credit worth nearly 5 times your actual capital, what we often call goodwill, while simultaneously becoming highly skilled in management and reducing the hours you need to work. At this stage, you will be fully prepared to open new branches or even launch an entirely new business. This table reflects a reality, because even banks and insurance companies operate on formulas far weaker than this. And yet, they remain stable and successful without collapse. Once again, I must emphasize that what I've shared here is only a small excerpt of financial management in business. A complete book will be available to you, covering in detail how to purchase goods, sell them, manage installment sales, handle customer payments, and even deal with post-dated checks. From my research, I have come to realize that successful and wealthy entrepreneurs have all relied on these very precise principles, which enabled them to achieve incredible levels of power and prosperity. Personally, I too followed these simple formulas and, as a result, reached an extraordinary level of wealth and business strength. These three crucial points can fundamentally change your financial situation. Let's briefly look at each one before we get to the core of the matter. First, capital. This is the money allocated to grow and operate the business. Second, savings. These are the funds set aside for stability and future opportunities. And third, your financial reserve or safety fund. This acts as a security cushion for unforeseen challenges. Now, let's dive into the main topic. 1. Capital. Capital refers to both your liquid, cash, and non-liquid assets, property, equipment, inventory, or goodwill, resources that form the foundation of your business structure. Managing capital effectively is one of the most important skills every entrepreneur must master. Here's a simple rule of thumb for starting any business. Do not invest 100% of your capital at once. Instead, put 60% of it into active business operations. Allocate 20% specifically for marketing and promotion. Keep the remaining 20% as liquidity, cash on hand, for flexibility. This liquidity, often called working capital, is the lifeblood of your business. For example, if you have $100,000 as total capital, a healthy distribution would be $80,000 in non-liquid assets, such as equipment, inventory, goodwill, or property, and $20,000 in liquid capital as cash in hand. Keep in mind that in some industries, the liquid portion may be in the form of quickly tradable goods. For example, in the gold business, jewelers typically hold $80,000 worth of finished gold, which is non-liquid, not for reinvestment, and $20,000 worth of raw or broken gold, which serves as the liquid working capital. The key principle is this: never exhaust your working capital. Suppose you run a home appliance business with a total capital of $1 million, of which $200,000 is liquid. If Samsung offers you a dealership for $200,000,
It would be a mistake to invest all your liquidity. Doing so would dry up your working capital, crippling your operations. But if the same dealership could be acquired for $100,000, that would be a wise move, since you'd still retain another $100,000 in cash flow. As a rule, your business growth should target a 20 to 25% increase in total capital at the end of each financial cycle. For example, if your total capital, cash plus assets, is $100,000 this year, your aim for next year should be $120,000 to $125,000. Important note: inflation is not growth. If inflation is at 20% and your capital increases by the same amount, that only means you kept pace with the market, not that you truly grew. Real growth means achieving 20 to 25% above inflation. So, if your $80,000 in non-liquid assets grows to $95,000 and your $20,000 in cash grows to $25,000, that's real progress. Finally, remember, wealth is built gradually. Don't rush into risky moves just to make quick money. Sustainable growth of 20 to 25% annually, compounded over 7 to 10 years, can turn into extraordinary wealth. Example of financial growth over 10 years, with approximately 25% annual growth. 2. Savings. In the previous section, we explained that your capital should increase approximately 25% each financial year to maintain precise control over your finances and career growth. But what happens if your actual profit is higher or lower than this rate? The answer is straightforward. If your financial growth falls below the approximate 25%, you should consult an advisor to scientifically bring your business back under control. However, be mindful that rushing for faster profits can be risky. In fact, there are two primary causes of bankruptcy, starting with weak liquidity and uncontrolled growth. Using the example of $100,000, a suitable profit after one financial period would be around $25 to $30 million after all expenses, or roughly $20,000 net per month. This profit should be divided between cash and non-cash capital, about $15,000 to non-cash capital and $5,000 to cash. Here, we introduce 7 golden rules for saving. Rule 1. Save surplus growth. If your profit is higher than expected, save the excess. For example, if the profit is $300,000 instead of $250,000, save the $50,000 surplus. Rule 2. Wait 4 months before using savings. Since the first months of savings may be uncertain, wait at least 4 months before making any decisions about spending. This allows your mind to establish disciplined financial habits, turning you into a professional entrepreneur. Rule 3. Spend savings from the 4th month onward. After the 4th month, start using your savings. However, this does not mean spending recklessly. It means addressing personal and reasonable needs while keeping business principles intact. Rule 4. Use savings for personal facilities. Use your savings for essential personal needs such as buying a car, furniture, household appliances, trips, and celebrations. This helps maintain your energy and credibility as an income-generating entrepreneur. Rule 5. Never overspend your savings. Only spend what you have saved. If you are buying a car on installments, ensure that you can continue saving the same amount each month to cover the payments. Overspending can severely harm your business. Rule 6. Spend wisely and avoid extravagance. Spending your savings does not mean excessive indulgence. Purchase based on necessity and reason. Even billionaires like Bill Gates don't spend all their savings on personal facilities. Manage your finances wisely. Rule 7. Do not use savings for new investments. Never use your savings for starting a new business or expanding an existing one without proper management, planning, and expert support. Growth should follow a gradual and controlled path. Your mind, like a train, has limited capacity and speed. Increasing speed without capacity will lead to problems. Focus on fundamental and gradual business growth until your venture reaches maturity. 3. financial zero, or piggy bank. Alongside savings and working capital, there is another component that can help manage your capital and savings, what I call the financial piggy bank. Your mind is like a bomb that needs a small fuse for each explosion. Daily, small amounts of money leave your financial system unnoticed, such as extra charges at gas stations, change from purchases, small expenses at pharmacies or supermarkets, minor spending on cigarettes or leisure activities. Even these small amounts, accumulated over time, can become significant. By consciously setting aside small amounts of money regularly, say $10 per day or more, you'll notice that they grow into a substantial sum. Collect worn or small denomination bills and convert them into larger ones periodically. Coins can also be collected and later converted into larger denominations. Do a quick, rough calculation right now and see how significant amounts of money you could have at the end of each year with just small daily savings. There is always some unaccountable money in your pockets that vanishes along with your other expenses. When I personally tried this experiment, I realized how remarkably my extra money had accumulated. Every day, save a very small amount that you feel won't harm your budget. For example, every night or occasionally, put aside 1,000 tomans or more in a separate box. After some time, you will see that you have collected much more than you ever imagined. Gather your old or worn-out banknotes and, after a while, exchange them for larger bills. Collect your extra coins, convert them into bigger amounts, and put them aside as savings. It does not matter how much you save. What matters is that your brain gets used to collecting extra amounts of money. The important point is that your brain becomes surprisingly disciplined and unconsciously transforms you into a wealthy person. Do not forget that such amounts usually end up in the pockets of beggars or people who are not truly in need. In this regard, set aside a small amount of money daily in a separate bank account, an amount that does not hurt your financial system in any way, so that you never even think about it. In fact, these are the very amounts that would have otherwise been spent uselessly and disappeared. Instead of ending up in your stomach, or in the pocket of panhandlers, or anywhere else, they will accumulate in a bank account where you won't even think about them. I call this type of money productive money. It is money that will come to your aid in situations you would never expect. Perhaps you have experienced moments when you came across a product or device perfectly suited to your needs at an unbelievably low price, but you lost the opportunity only because you didn't have the money. In such moments, this financial zero, which is like the blood in the veins of your business, comes to your rescue. If you use this money, you must immediately return it to its original place from the profit you gain.
One day, by coincidence, I went to my friend's car dealership to ask him a question. While we were talking, a man walked in who wanted to sell his car. The car had only 3,000 kilometers on it, practically brand new. A brand new version of the same car was priced at $40,000, but this man was willing to sell it for $31,000. At that moment, no one was ready to buy. I asked my friend how much the car was worth. He told me at least $36,000. So I asked him, "Why don't you buy it yourself? Isn't that a good profit?" My friend replied, "We usually don't use our cash for quick trades like this, but we can hold on to it and sell it for him." Then I asked the seller why he was offering the car at such a low price. He explained that he had bought a piece of land at least $25,000 below its market value and now urgently needed $30,000 in cash. Right there, I offered to buy the car, but I asked my friend to check its condition first. If everything was fine, I would take it. That same night, I completed the deal and left the car at the dealership for resale. Within 1 week, I sold it with a profit of $5,000. I returned the principal amount to my financial zero, added the $5,000 profit to my savings, and even deposited about $100 of that profit back into the zero account. Here's another example. One of my students told me that after 2 years of attending my classes and consistently applying the savings and financial zero method, he experienced a turning point. His profession was engraving on objects, and one day, a man approached him offering a CNC machine for sale. This was exactly the type of machine he had always wanted, but he had never been able to afford one. The machine's actual price was $1,500, but the seller said he was willing to let it go for $600 because he was about to travel abroad and had already gotten enough use out of the machine. That student explained, "On that very day, I happened to have $500 cash in my financial zero account money I had never paid attention to, only thanks to learning this principle in your classes. Because of that, I was able to buy the machine. Now, after 1 year of working with it, I can easily recover the entire amount I took from the financial zero and return it to its place." But my friends, my point is not that you should constantly use your financial zero for every transaction. Depending on special circumstances and sudden profitable opportunities, you may use your financial zero. In the first example, if I had bought that car just for personal comfort and daily use, I would have destroyed my financial zero. Never forget situations such as economic crises, earthquakes, fires, theft, or other unexpected events are dangerous for everyone, and you are no exception. That is why your financial zero can serve as a kind of business insurance, always there as a backup for you.
I hope you found the information we've covered so far truly valuable. Now, it's time to move on to Chapter 4, Advertising. This chapter is packed with fascinating and powerful insights that can take your business growth to an extraordinary level. So, let's get started with this exciting new topic.